Trading psychology. How the mindset makes or breaks your profits. Before we dive in, advertisements may pop up in this video. Please do not interrupt the advertisements. Please allow them to play through as a thank you to me for bringing you this honest, valuable information for free. Now let's continue. You're sitting in front of your laptop, late on a Thursday evening. The house is quiet. Your portfolio dashboard is open, green numbers, red numbers, percentages you understand and percentages you pretend to understand. And there's this feeling. Not panic, not excitement, just this low-grade hum of uncertainty. You click refresh. The numbers shift slightly. You close the tab. Open it again 5 minutes later. And somewhere in that cycle, you realize you're not managing your wealth. You're managing your anxiety about your wealth. This is where the real damage begins. Not in market crashes, not in bad stock picks, but in the invisible psychological patterns that quietly, consistently erode long-term capital preservation before you even realize what's happening. The mistakes that cost accredited investors millions aren't usually about strategy. They're about the hidden friction between what we know we should do and what we actually do when emotions take over. See, here's what nobody tells you about portfolio management for accredited investors, about wealth optimization, about tax-sheltered growth strategies. The technical knowledge is actually the easy part. What destroys wealth over decades isn't ignorance. It's the psychological mistakes we make in the space between knowing and doing. The internal scripts we run without noticing. The identity conflicts that turn disciplined plans into emotional reactions. And right now, in this moment, we're going to name those patterns. We're going to pull them into the light. Because once you see them, once you really understand how they operate, they lose their power over you. The invisible enemy. So let's start here. There's an enemy operating inside every long-term financial decision you make, and it doesn't look like greed or fear, at least not on the surface. It looks like reasonableness. It sounds like caution. It feels like common sense. It's the voice that says, maybe I should wait until I understand this better before I commit. It's the hesitation that feels like wisdom but functions like avoidance. And here's the thing. You can't logic your way out of this pattern because it doesn't live in your logical mind. It lives deeper. In the part of you that learned, probably decades ago, that mistakes with money are shameful, that losing is personal, that not knowing something means you shouldn't be in the room. This is the real psychological mistake that destroys wealth. We confuse emotional comfort with financial wisdom. We wait for the feeling of certainty before we act. We interpret our anxiety as information rather than noise. And in that waiting, in that misinterpretation, compound growth evaporates. Tax-advantaged years pass. The behavioral edge that separates decade-long wealth accumulation from decade-long stagnation just quietly dissolves. You know what I'm talking about, right? That moment when you researched the ETF, understood the expense ratio, saw the historical returns, recognized the diversification benefit, and then didn't pull the trigger because something just didn't feel right yet. Nothing felt wrong, but nothing felt certain enough. So you waited, and waiting felt responsible. It felt measured. It felt like the mature thing to do. But actually, it was just fear wearing the costume of prudence. The identity conflict. Now let's go deeper, because this is where it gets uncomfortable. There's a version of you, let's call it your financial identity, that's been built over years, maybe decades, from every money experience you've ever had. Every time your parents fought about credit card bills. Every time you felt shame about not having enough. Every time someone made you feel stupid for not understanding compound interest or capital gains or dividend reinvestment strategies. That identity is still here. It's still running the show, and it has a very specific job: keep you safe from the feelings associated with financial mistakes. Not from actual financial mistakes, from the feelings. And here's the cruel irony. The psychological defense mechanism designed to protect you from feeling bad about money is the exact thing preventing you from building long-term wealth. Because building wealth, real, sustainable, generational wealth, requires you to act before you feel ready. It requires you to sit with uncertainty while your retirement accounts compound. It requires you to maintain portfolio discipline during corrections when every emotional signal in your body is screaming, "Get out." See, the person you've been financially is not the same person who builds the wealth you want. There's a gap, an identity gap, and crossing that gap means feeling the discomfort of not yet being the person on the other side. Most people never cross that gap, not because they lack knowledge, not because they can't afford to invest, but because the discomfort of the crossing feels like evidence that they're doing something wrong. They interpret the psychological friction as a stop sign instead of a growth signal. The escalation of avoidance. Let me paint you a scenario and tell me if this resonates. You've got a 401k, maybe a Roth IRA. You're contributing something, maybe not the max, but something. And for years, you've been meaning to really optimize your asset allocation. You've been meaning to understand whether you should tilt more toward international diversification or stay domestic. You've been meaning to figure out if your bond exposure is appropriate for your risk tolerance and time horizon. You have all these intentions, but every time you sit down to actually do it, this wave of something comes over you. It's not quite overwhelm. It's not quite fear. It's more like a vague sense that you're about to expose how much you don't know. That you're about to make a decision that reveals you're not as financially sophisticated as you should be at your age. So you read one more article, watch one more video, tell yourself you'll handle it next quarter when things are less busy. And here's what's happening beneath that. You're avoiding the identity confrontation. You're avoiding the moment where you have to be someone who makes a major financial decision without perfect information, who acts despite uncertainty, who claims the identity of investor rather than just person who has some money in accounts. And every time you avoid that confrontation, the psychological pattern gets stronger. The avoidance becomes evidence. See, you're not really an investor. You're someone who pretends to understand this stuff, but doesn't really. You're not like those people who confidently rebalance their portfolios and talk casually about tax loss harvesting strategies. This is the hidden mistake, the psychological one, the one that compounds in reverse. Why discomfort intensifies before growth. Now, stay with me here because this is where most people check out, right at the edge of real transformation. There's this moment, right before meaningful financial behavior change, where everything gets harder, not easier, where the resistance intensifies, where suddenly every reason not to act seems completely rational and every reason to act seems naive. This isn't a bug. It's a feature. Your psychological system is designed to maintain homeostasis, to keep you the same. And right before you change, right before you commit to maximizing your tax-sheltered growth, right before you automate your investment contributions, right before you hire that fee-only fiduciary advisor you've been putting off, your brain throws up every defense it has. It surfaces every past financial mistake. Every time you lost money. Every time you felt stupid. Every time someone made you feel small for not knowing. And it packages all of that as current wisdom, as prudence, as just being realistic. But here's what's really happening. You're standing at the threshold between who you've been and who you're becoming. And that threshold is supposed to be uncomfortable. The discomfort isn't evidence you're making a mistake. The discomfort is evidence you're about to grow. Most people experience that spike in resistance and interpret it as a stop signal. They think, see, something doesn't feel right. I should wait. But the successful wealth builders? They recognize that spike as a confirmation signal. They understand that real financial transformation happens through discomfort, not after it passes. Think about the last time you actually made a significant financial decision that turned out well. I'm talking about something real, moving a substantial amount into a diversified index fund portfolio, finally maxing out your tax-advantaged accounts, hiring a professional to help with estate planning. I guarantee you, right before you did it, there was a moment of intense resistance, a moment where it felt wrong, where you had to act despite your feelings, not because of them. That's the moment where wealth is built, right there, in that uncomfortable gap between knowing and doing. The memory trap. Let's go even deeper, because there's another layer here that quietly destroys long-term wealth accumulation. Your brain doesn't remember financial experiences accurately. It remembers them emotionally. An emotional memory is a terrible guide for long-term investment strategy. Here's what I mean. If you lost money in 2008, your brain didn't record temporary market correction within normal historical volatility ranges. It recorded devastating, terrifying, identity-threatening loss. And that emotional memory is still active. It's still influencing every portfolio decision you make in 2026. When markets get volatile, you're not responding to current risk. You're responding to emotional memory. And emotional memory always distorts toward worst-case outcomes. This is why people who lived through the Great Depression hoarded cash for the rest of their lives, even when inflation was quietly eroding their purchasing power. It's why someone who got burned by an individual stock never trusts equities again, even though diversified index funds have entirely different risk profiles. It's why one bad experience with a financial advisor makes someone avoid professional guidance for decades, even though that avoidance costs them millions in lost wealth optimization. Your past financial experiences aren't giving you wisdom. They're giving you trauma-based pattern matching, and you're treating those patterns as insight. The psychological mistake is this. We think we're being careful. We think we're learning from experience. But actually, we're letting outdated emotional programming run sophisticated financial decisions that require objective analysis, proper risk assessment, and long-term strategic thinking. Every time you check your portfolio multiple times per day, that's emotional memory, not portfolio management. Every time you move to cash during volatility, that's trauma response, not risk management. Every time you avoid important financial planning conversations because you feel overwhelmed, that's avoidance, not prudence. And here's the really brutal part. Emotional memory compounds just like wealth does. Every time you act on it, you strengthen the neural pathway. Every time you let anxiety drive decision-making, you train your brain that anxiety is useful information rather than background noise. You're building the wrong muscle memory. And that muscle memory is costing you exponentially over time. The confidence trap. Now, let's talk about something that sounds counterintuitive. Waiting until you feel confident about a financial decision is often the worst possible strategy. Here's why. Confidence, in investing contexts, is usually a lagging indicator. You feel confident after markets have been going up for a while, after your portfolio has grown, after everyone around you is talking about their gains. That's when you feel ready to invest more. But that's also when valuations are elevated and forward returns are compressed. That's when risk is actually highest. The disciplined approach, the wealth-building approach, is the opposite. It's taking action when you're uncertain, when markets are volatile, when everyone else is scared, when your emotional system is telling you to wait. Because here's what real portfolio management for long-term capital preservation looks like. It's boring. It's mechanical. It's continuing to dollar-cost average into your diversified holdings regardless of how you feel. It's rebalancing on schedule, not when it feels comfortable. It's maximizing your contributions to tax-advantaged accounts in January, not in December when you finally feel like you have enough information. The psychological mistake is thinking that successful investing should feel good, that it should feel confident. That clarity comes before commitment. But actually, the most important financial actions you'll ever take will feel wrong in the moment. They'll feel premature. They'll feel like you're acting without enough information, without enough certainty, without enough something. And that something you're waiting for? It never arrives. Because you're waiting for an emotional state, confidence, that only emerges after sustained action, not before it. This is the identity shift that most people never make. From someone who acts when they feel ready to someone who acts according to principle regardless of feeling. That shift, that's where multi-generational wealth gets built. The compound error. Let me show you what this looks like over time, because the impact isn't immediate, it's exponential. Year 1. You delay starting or increasing your retirement contributions because you want to understand everything first. Cost? Maybe $10,000 in missed growth and tax benefits. Painful but recoverable. Year 5. You've now missed 5 years of compound growth and tax-sheltered appreciation. That original $10,000 would be worth significantly more. But more importantly, you've spent 5 years reinforcing the psychological pattern. Hesitation feels like wisdom. Delay feels like prudence. Year 15. The gap is now 6 figures. Not just in account value, but in psychological momentum. You've trained yourself for 15 years that meaningful financial action happens later, when I'm ready. That pattern is now deeply embedded. It's part of your financial identity. Year 30. The gap is multi-generational. It's not just your retirement, it's the legacy you can't leave. The options your children won't have. The freedom that's been exchanged for the feeling of safety that came from never acting prematurely. This is what hidden psychological mistakes look like when they compound over decades. They don't announce themselves. They don't feel catastrophic in the moment. They just quietly, consistently redirect the trajectory of your wealth from where it could have been to where it ends up. And the cruelest part? You won't even know what you missed. Because the alternative timeline, the one where you acted despite discomfort, where you built discipline despite uncertainty, that timeline is invisible. It doesn't exist except as vague regret. The real transformation. So here's what has to happen. Not might happen. Has to happen. You have to build a new relationship with discomfort around financial decisions. Not eliminate it. That's impossible and counterproductive. But reinterpret it. When you feel that spike of resistance before increasing your investment contribution, before rebalancing your portfolio, before finally hiring that CPA to optimize your tax strategy, that feeling is no longer a warning. It's a compass. It's pointing you toward growth. When you feel uncertain about a long-term investment decision despite having done the research, understood the fundamentals, and confirmed alignment with your time horizon and risk tolerance, that uncertainty is no longer evidence you need more information. It's evidence you're about to cross an identity threshold. This is the shift. From interpreting feelings as data to recognizing feelings as friction. Expected, normal, meaningless friction that occurs at the boundary of growth. And here's what changes when you make this shift. You stop waiting for readiness and start building through action. You stop seeking perfect understanding and start implementing disciplined systems. You stop trying to feel good about your financial decisions and start making decisions that will feel good about 30 years from now. You become someone who maximizes tax-advantaged contributions in January regardless of anxiety, who rebalances systematically regardless of market conditions, who maintains portfolio discipline regardless of financial news cycles, who acts on wealth optimization strategies when they're appropriate, not when they feel comfortable. This version of you, this isn't fantasy. This isn't some impossible ideal. This is just you on the other side of recognizing that psychological mistakes are the real threat to long-term wealth, and that those mistakes are optional once you see them clearly. Close on integration. So let me ask you something, and I want you to really sit with this question. What would change if you stopped treating your emotional resistance to financial action as valuable information and started treating it as predictable noise? What would your portfolio look like in 5 years if you made decisions based on principle rather than feeling? What would it look like in 20? And more importantly, who would you have to become to do that? Because that's really what this is about. Not tactics, not strategies, not finding the perfect investment vehicle or the optimal asset allocation, though those matter. It's about becoming someone who acts through discomfort instead of waiting for it to pass. Someone who recognizes psychological patterns as patterns rather than truth. Someone who builds wealth systematically because that's who they are, not because they feel inspired or confident or ready. That person exists. They're not imaginary. They're not reserved for people with more knowledge or more resources or more natural discipline than you. They're just on the other side of a decision to stop letting hidden psychological mistakes quietly destroy what could have been built. The question is, are you ready to cross that threshold? Not when it feels comfortable, not when you have more information, not when circumstances are perfect. Now, through the discomfort, through the uncertainty, through the identity friction, because that's where long-term wealth actually lives. Right there in the gap between who you've been and who you're becoming. And the gap? It's been waiting for you this whole time. If you found this deep dive helpful, please like the video and let me know in the comments which mindset challenge is your biggest hurdle. For more on high-level wealth strategies, subscribe and join our community of dedicated investors. This content is for informational and educational purposes only and should not be considered financial advice. Investing involves risk, including the potential loss of principal. Please consult with a qualified financial professional before making any investment decisions.